Hi, I'm Michael, and for week 3 of accounting, I have chosen to look at the statement of cash flow process. When we look at the statement of cash flow, we are able to further dive into this process by looking at the classification of cash flows. When we look at the statement of cash flows, we look at its importance. Its major importance is that it is used by investors to help predict if a company will be successful in the future. They do this by looking at the 3 classifications: operating activities, which is the day-to-day activities of a firm; investment activities, which reports on receipts and payments that affect the long-term assets; and then financing activities, which reports cash flows that affects the equity of a firm. The classification process for cash flows is very important because it helps an investor see what line items are being affected by looking at each line item by its class of operating activities, investment activities, and financial activities. To further discuss this topic, we can look at our next 3 analysis of a retail firm. When we look at a department manager in a store, we can consider their recording of purchases of goods as an operating activity. By a store department manager recording their purchase of goods as an operating activity, an investor is able to see this line item being recorded in the correct part of the accounting for this firm. When we next take a look at the mid-level professional, we can consider a general manager, and when a general manager has to decide whether or not to acquire new fixtures for a store. Well, a fixture for a store is a long-term investment asset for a company that will also depreciate over time. When a general manager purchases this item, it becomes an investment activity line item for accounting purposes. So therefore, in the real-world application, investment activities in most retail firms fall on the general manager of a store. When we look at the final part of the application process for activities of cash flow, we look at the financing activities. Well, when a firm decides to create stock, this is done at the executive level. When a firm sells stock to investors, this is recorded as a financing activity in the cash flow process. When recording this part of the cash flow process, we are able to see all 3 categories and how they affect a firm, each with their own uniqueness and how they must be placed in the correct category. When a retail store purchases its goods, it has to consider multiple factors each year. At the end of the year, a firm must record its shrink. Shrink is the loss of stock through theft, such as pilferage or through theft by employee stealing. When a company purchases goods, it has a dilemma to consider of how it reports its losses. When a store sits on an item too long, it may consider to discard the purchase and throw it away and incorrectly report this as shrink. When a firm incorrectly reports something as shrink, we need to consider Proverbs 13:11, which states, "Wealth obtained by fraud dwindles, but the one who gathers by labor increases it." So if we look at this, we can consider, well, if some firm takes goods and throws them away to use the process of shrink, they're incorrectly reporting this as a cash loss on their financial statements. When a firm can consider selling said goods at a loss and then be more diligent in the next year of producing goods they know that a consumer will want to buy, they use their labor of selling to obtain profits through honest practices and not over reporting of shrink.